If you're a UK taxpayer earning more but feeling poorer, watch this. I'll explain how frozen thresholds quietly cost you hundreds. I'm with Fairview Accounting.
Right, so picture this. You're a UK PAE employee and you've just landed a hard-earned pay rise or maybe a nice year-end bonus. You open your payslip expecting to see a healthy bump in your take-home pay, but the extra cash just isn't there. Well, if you're earning close to or over £100,000, this explainer is made specifically for you. But honestly, even if you're a bit further down the income scale, you're almost certainly getting hit by this exact same hidden mechanism. Look, you haven't messed up your budgeting. What you're experiencing is actually a profound structural shift in the UK tax system. Take a look at this number, £50,270. This is the exact figure where a supposed pay bump can actually start costing you dearly. It's the higher rate threshold in the UK. The moment you cross this line, your marginal tax rate jumps up to 40%. But here's the thing. Because of a policy that's fundamentally reshaped the UK economy, crossing this threshold is now happening to literally millions of people who never, ever expected it. So you might get what we call a nominal pay rise, so a 5% bump to help you keep up with the cost of living. Sounds brilliant on paper, doesn't it? But in reality, your actual take-home pay shrinks. By the time inflation erodes the purchasing power of those pounds and the taxman takes a 40% slice of the increase because you've crossed a frozen boundary, well, that 5% raise completely vanishes. It's a really costly oversight so many people make, celebrating a gross salary increase without considering the hidden, somewhat brutal mechanics of the UK tax code. So let's dive into Section 1, the stealth tax trap. Now, you might be wondering, why exactly does your pay rise feel like a pay cut? The stakes here are incredibly high, and honestly, they just got higher. The Chancellor recently announced that the freeze on personal tax thresholds, which is what dictates when you start paying higher rates of tax, is being extended all the way out to April 2031. Think about what that means. The tax boundaries aren't moving an inch, but your wages and inflation absolutely are. The concrete consequence of this freeze is, frankly, staggering. Back in the 2019 to 20 tax year, there were roughly 3.8 million higher rate taxpayers in the UK. By the 2023 to 24 tax year, that number jumped to 5.7 million. That is nearly 2 million more mid-level professionals. We're talking teachers, nurses, managers, who've been quietly pulled into the 40% tax bracket. And it's not because they suddenly became vastly wealthy. It's simply because their wages grew while the tax boundary stood completely still. Okay, moving on to Section 2, Understanding Fiscal Drag. To really understand how to protect your income, we need to break down the core mechanism causing this massive squeeze. Fiscal drag happens when the government chooses to freeze income tax thresholds by less than average wage growth or inflation. It's what we call a stealth tax. It raises tens of billions of pounds for the exchequer without the government ever having to officially raise headline tax rates. The headline rate stays at 20 or 40%, so the government can easily say, we haven't raised taxes, but your effective tax burden, that goes up every single year. This all starts right at the bottom with your personal allowance, £12,570. That's the amount you can earn entirely tax-free. But here's the catch. It has been frozen at this exact figure since 2021. Just think about how much the cost of living has skyrocketed since 2021. Inflation has severely eroded the real-world value of this allowance. And observe how this builds over time. Back in 2021, this freeze was announced as a temporary 4-year pandemic recovery measure. Then, it got extended to 2028. And now, it's been pushed all the way out to 2031. What started as a quick, temporary fix has morphed into a permanent, decade-long structural shift in exactly how the UK taxes its workforce. The end result of this decade-long freeze is that it actively penalizes your career progression. If you're a middle-income earner crossing that £50,270 line, you are doing more work, taking on more responsibility, and getting a raise literally just to stand still financially. But if you're a higher earner, well, things get significantly worse. Which brings us to Section 3, the 60% trap. I want to ask you a really direct question here. What exactly happens when your gross pay ticks over £100,000? Most people just assume you keep paying your 40% higher rate tax until you hit the additional rate threshold at $125,000. But unfortunately, that assumption is a very costly error. £100,000. This exact figure is where the absolute most punitive quirk in the UK tax system kicks in. The very moment you cross this line, you begin to lose your tax-free personal allowance. Here is how the math works. For every £2 you earn over £100,000, the government takes away £1 of your tax-free personal allowance. So not only are you paying 40% tax on the new money you earned, but another chunk of your previously tax-free income is suddenly dragged into the 40% bracket. When you combine those two effects, it creates an effective marginal income tax rate of 60% on any earnings within this specific band. And if you add in the 2% employee national insurance contribution, your effective marginal rate is a staggering 62%, meaning you get to keep less than 40 pence of every extra pound you earn. Incredible, right? Because this £100,000 threshold has been frozen since 2010, the number of people caught in this trap has absolutely skyrocketed. HMRC projections show that over 2 million workers will be caught in this trap by the 2026 to 27 tax year. The number of people earning over £100,000 has almost doubled in just 5 years. Thousands of senior professionals, often referred to as Henrys, which stands for high earners, not rich yet, are finding it incredibly difficult to build wealth because of this aggressive double hit of inflation and stealth taxation. So, what can we do? Section 4, how to fight back. We know the thresholds are frozen and we know the traps are set. But here is the specific, single action you should take this week to mitigate this stealth tax and preserve your hard-earned money. First, check your latest P60 or your current payslip to find your exact gross pay figure. Second, look at how close you are to the £50,270 higher rate threshold or the £100,000 trap threshold. Third, if you're bleeding into these punitive zones, calculate that excess amount and ask your employer to divert it directly into your workplace pension via salary sacrifice. Doing this legally reduces your adjusted net income, bringing you back below the threshold, saving you from that brutal 60% tax rate and preserving your personal allowance. Now, beyond salary sacrifice into your pension, which, by the way, also saves you and your employer national insurance, there are a few other powerful levers you can pull. Making charitable donations via gift aid operates really similarly to pension contributions by lowering your adjusted net income. You should also absolutely ensure you're maximizing your £20,000 ISA allowance to shield your investment growth and interest from further taxes. And if you have a spouse earning below the personal allowance, look into transferring £1,260 of their allowance to you via the marriage allowance. The bottom line, you cannot change the government's frozen thresholds, but you absolutely can restructure your taxable income. I want to leave you with this stark reality. The tax system hasn't necessarily become more complicated overnight, but it has certainly become a lot less forgiving. Small income changes can disproportionately affect your take-home pay, making proactive planning absolutely essential. Please do not let your next hard-earned pay rise or bonus get quietly swallowed by fiscal drag. Review your exact tax position against these frozen thresholds before your next payday, and take control of your adjusted net income. Thank you so much for joining me for this explainer, and I highly encourage you to take that single action step today.